All right, happy Saturday, everyone. This is Futures Barizio here, just after 2 p.m. on August 30th, 2025. Hope everybody had a great week. Um, just a reminder, we are heading into a long holiday weekend in the U.S. Labor Day on Monday, so markets will be, if not closed, very slow on Monday. So I don't expect there to be any trading at all on Monday. If there is, it'll be if for the forex traders, it'll be during the London session, or for futures traders, or I guess any market, it would be during the overnight session, London type, European sessions. But the U.S. sessions will either be closed or just very very low volume. So I don't suggest trading during those, after that European open time on Monday. But markets should, resume pretty normal operations on Tuesday. So, okay. So, as always, though, make sure you smash that like button, subscribe to the channel. Any questions, comments, leave them down below. So I made a couple of videos recently about just, for those of you that like to use some indicators, something on your chart, other than just pure price action, which is still, like I said, no matter even if you're using indicators, market structure and price action still the most important in terms of technical indicators than technical action than any indicator is. Okay, so just always keep that in mind, no matter what you put on your chart, because all these other indicators are lagging and are using past price action to calculate whatever they show. So regardless of whether they're lines or bars or oscillators or graphs or whatever, they all use price data that's already happened. All right. So this is a super simple setup. I think I made one using the 220 SMA. So this one here, I'm just going to use just the 200. So that's what this green dash line is, the 200 simple moving average. And this is a stochastic oscillator. I've used the CCI, I used the stochastic. They're going to give you very similar signals. It's really just a matter of which one you prefer. The CCI is a little less customizable. There's only one input setting, whereas the stochastic has three input settings, and two of them in particular will really allow you to customize it. So if you like to be able to really kind of tweak the indicator, then the stochastic is probably better. But they're both oscillators, meaning they're momentum indicators. They kind of show you what the momentum is in the market. And oh, that's weird. Hold on one second, guys. Well, anyways, guys, I don't know what happened there. I had my webcam that I have mounted on top of my monitor all of a sudden started acting up, and it flipped over to my computer camera, which is what you're seeing now. So, whatever, you get to see a little bit more of me than you probably need to. But anyways, so this is the stochastic indicator at the bottom, and I know you can't see off to the left, so I'm going to show you the settings I have this on. Um, So I have this set at the percent K at 15, the slowing average at 10, and the percent D at 3. And I left it at just simple, and that's it. On the close, and that's it. So 15, 10, 3, or 15, 3, 10, it'll display on your MetaTrader chart, because it displays it as percent K, percent D, and slowing. But these are the settings I have here. Settings, you really have to kind of tweak it based on the market and the time frame, and because certain assets are going to respond differently. The stochastic will respond differently, but I found that these settings are pretty good for kind of day to swing trading time frames, 15-minute to 1 hour, somewhere in there, at least for what I trade. I find this is about the best. Again, there's never going to be perfect. You're always going to have some times where you're going to miss signals, and other times where you'll get a false signal, and the more you try to tweak it, the more chance that will happen. If you shorten these numbers up too much, you will get more signals, but there'll be more falses. So you may have, take more losses because you're getting more false signals. The longer you set it, the fewer signals you get, but the much higher probability that you'll miss a trade if you're taking it based on the indicator giving you a signal. In this case, like if you're looking for a long, having the signal cross out of the oversold area and start moving up again, if you have the indicator set too high, it may never get down into this area before the trend continues. So there's no perfect setting. So 15-10-3 is how I have this. Okay, just so you know, and it's the same for all these four markets that I'm gonna go over. What the heck just happened there? Okay. So we'll look first at crude oil. So this is the hourly chart. Now, if we look at this, this is one that that's not really great in terms of direction right now, because even if I go out to the 4-hour chart, we're rather sloppy in here. The 1-hour chart, we're kind of moving sideways. So this isn't one that I really see a nice strong trend on right now. It's really hard to say. I mean, we're trading above. So the purpose of the 200 moving average is supposed to give you a quick snapshot of the overall direction of the market. So essentially, if the price is over the 200, then the market's more long, more bullish. If it's trading under the 200, it's more bearish. But in sideways markets, you'll have the moving average, constantly chop between, above then below, above then below. If you've seen that happen on your chart, that means you're in a kind of a consolidating market, and it's not great for trend trading. So, you may want to find something that's a little bit more defined. So on this market, let's just talk about, swing areas that we need to watch here. So if just looking here, we've got this swing high, all right, and we've got the last swing low after that swing high was right here. So you can see we're kind of like in between right now, these two areas. And you can see price did hold the 200 moving average when it came down here. It held it pretty perfectly and then started going up. I wouldn't say this is very bullish though. This looks kind of weak, in terms of this action back up here. The price is kind of overlapping, a lot of candles over. It's not really making a lot of progress. And you can see even looking at the oscillator came up. I mean, it's not divergence because we didn't make a new high, but you can see even the oscillator as it comes back up is choppy compared to this smoother move down here. So I'm really kind of neutral, but I'm probably more bearish on oil just because of this kind of weak price action back up. And also if we go out to a 4-hour time frame, potentially, breaking below the 200 here, broke below, came back up, retested it, and now breaking. But essentially with this, I'm going to wait and see because this is one of the four that I'm not really too clear on the direction. So if we get a break, have price come up, take out this high and start moving higher, great. Then we'll start looking for longs. But I would probably need to see price start to move below these lows here. And the moving average is almost acting like a trend line here too. To see price come down and take out these lows and start moving to the downside. At least this one right here. Now the overall swing is right here. But if we're looking at market structure, we have this was our most recent internal swing low. So I would need to see price break through here and maybe even through here before price would continue lower. So I'm kind of neutral, but you can see, this is why sometimes, like I said, moving averages and oscillators are no good in consolidating markets or where there's no clear direction. All right. So we'll put that one aside and let's move on to natural gas. This is the 15-minute chart. Let's start with the 1 hour. And you can see clearly on the 1 hour we were going down. You can see the 200 moving average was giving us some nice areas here. As price approached the 200, it sold off again. And you can see up here we came up, broke through temporarily. Looked like we were starting to go down again right here right? This was kind of a pretty classic, right? Down, retrace, and then boom. Well, that never happened, and we started going higher. Now, you're kind of, one of your first clues would have been down in here where we put in two higher lows. All right. Now, you got to be careful with these because oftentimes you can get on a in a downtrend, you can and price starts to correct, you can get higher lows because it's just part of the correction. This is where it kind of fools traders into going short, thinking this is the continuation of the downtrend. People go short here and then boom, it comes up, spikes through, takes them out. They got their stop losses sitting up here. You can look back here. We kind of almost had that situation here. Price went down, started to retrace. All right. It came down, popped up, came down, popped up again. So it's kind of the same thing here. But you can see we put in two higher lows. Okay. Technically, we put in three. I mean, even we just look at an area, right? We got this here. So this is kind of your first clue that maybe we're going to change direction here. You know, where price, obviously, the market's being bought every time it tries to go lower again. So even though we're still trading below the 200, this is, even if you're saying, okay, well, I'm not going to take any longs yet because we're still trading below the 200. That's fine. Because in this case, you know, if you had gone long, you would have been set well. But if you didn't, say, well, we're still trading below, but I'm watching this. I see all these swing lows that are higher. This one's higher than this one. This one's higher than this one. And then we break through here. We come back. We retest the 200 again. Fail to break through. And then boom, now we go up. Okay. And then, of course, we put in the most recent swing low was right here, which was on Friday, yesterday, and going higher. Okay. So now if we look down at the oscillator, now this is what I was talking about with potentially. Now, this the best way, the most low risk ways to use this oscillator is to, if you're looking for long positions, to wait for price for the oscillator to get down below the 20 line down here. So this is considered oversold. And then when it starts to curl back and you know starts to break through that 20 line back to the upside, that's an entry. Okay, if you're looking for longs. If you're looking for shorts, it's just the opposite. You're going to wait for price to get back above into the oversold, quote unquote, area up here above 80. And then when it turns, it goes lower and breaks back through here. That's a potential short signal, which you can see that would have worked out over here. Okay, because at this point, we were only looking for short positions. All right. But you can see here that neither time, well, I mean, you wouldn't necessarily have been taking longs in here anyways because we're still below the 200. But neither time the oscillator got down into the oversold area. And this can happen a lot of times when the buying, in this case, is strong. You know, there's not enough selling pressure and weakness to push this down. Now, one way you can kind of force that is to maybe go to a little bit shorter time frame. And if we go to the 30-minute, which is a nice shorter time frame, you can actually see on the 30-minute how this changes. Now, we still wouldn't have necessarily taken any of these longs. We still, here's those three lines, right? Still below the 200, okay? But then we broke through it, and then we came back. And right in here, this is not a great signal, but right here we had the oscillator. So now we got price trading above the 200. We have the oscillator comes back through the oversold area. Now, the only problem I have with this is because where it came through, if we put our crosshair on there, where it traded back above, it's all these little tiny candles. So, you know, when you want to see a long position, you know, potential long, you want to see some good, strong price action in that direction. We have very weak, small little candles here. But technically, you know, if you had taken this, yes, you would have had to withstand a little drawdown because price came up, started going down, you know, so depending where your stop loss is. But then the market spiked through right here, okay, and started going up, all right? So that's one area you could do this. Now, if you want to wait, so let's put a rectangle around this area right here. And now let's just jump for a laugh down to the 15. Now on the 15, here's that same kind of false entry right here. Okay, this is the one I was showing you on the 30 minute. Came up through here. We got these really small little candles. All right. And then it came down on this retracement right here. And then look at this next signal. The candles are much bigger and much more impulsive. Now, the sellers did try to come in one more time and brought us back to this entry. And then boom. Okay. So what's the point of this? The point of this is if you're using like the 30 minute to the 1 hour time frame, you see price get above the moving average and you're thinking, and you start to change your bias to more long because you can see the sellers are not able to grab this price and go lower again, then I would suggest if you want to use the oscillator, that you jump down to a shorter time frame, the 30 minute, 20 minute, 15 minute maybe. Even the best signal here would have been on the 15. Okay, we would have gotten this signal right here on the 15. All right, right here. This was the best signal right here inside this rectangle. And if we go back to the 1 hour one more time, there's that signal inside on the 1 hour. Now you can see you wouldn't have gotten it here on the oscillator because it's only about, in the middle of the range here. But obviously as you go down to a shorter time frame, it's taking more current price action shorter because you're looking at the look back periods a lot shorter. And so it's going to pick up more of this buy signal because of all this, more recent bullish price action. And that's why on this pullback, it dove down here because it's picking up all of this bearish action right here and it's really amplifying it down into the oversold area. So my point would be, if you're then beginning to see a potential shift in direction, especially a shift in direction from, a longer term downtrend to a longer term uptrend, that first move up is probably going to be hidden in the oscillator. And so if you start to see this, you might want to go down to a 15 minute, look for your signal here. Okay. So let's just keep moving forward here. If we want to stay on the 15 minute chart, we would have had another signal right here. Okay, this one was not great. You would have gotten in near the top. Price went sideways, 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 and then actually went down. So depending where your stop loss was, but you can see it came down and it held the 200 period exactly. All right, and then we had another signal. Price still didn't get down into oversold, but we had another signal. And you will notice that the 200 period moving average a lot of times will hold price, and this is a good place to get in because the 200 is being watched by a lot of traders. Now, if we go back to the 30 minute, do we have any signal here? No, we've got this one, which is not a great signal. Again, if you had gotten in either here or on this signal on the 30 minute, as long as your stop loss was in a good spot, you would have been all right. I mean, you would have had to have withstand some drawdown, but it just depends where your stop loss is. If you had your stop sitting just below this swing over here, which is probably a very common spot because it's at a recent swing low, you would have been stopped out right here. And this is a classic liquidity grab where they push price down, trigger off all the stop loss orders sitting right here, grab that liquidity, and then go higher. So be cautious about this stuff because this is the manipulation that goes on in the market. All right. Because again, you likely would have put your stop loss. Let's say you went long somewhere in here. You would have put your stop right here underneath this swing. And then price comes down. Look at that. Wicks through on one candle, takes you out. And then the very next candle comes back and the price starts going up. All right. Don't let that happen. If you have to position smaller, fine. But put your stop, like 2 swings away. So maybe down here. That would have been plenty of breathing room. And then as price starts to go in your direction, you can move your stop back up closer to your entry and take some of the risk off the table. Because this is a decent sized stop loss, not huge, but if you position it, let it go and start going into profit and then move the stop loss up, like I said, back to either close to break even or at least to a much smaller stop loss area so that if it does turn around and come back against you, at that point, your risk is very low. Okay. So now, so the bottom line on this chart, if we just clean this all up now, all right, is we just want to um, wait for some kind of pullback now. Now, again, you can see what's happening here. When this market pulls back, it's not particularly great, all right, because on this time frame, it's only coming back on the oscillator to about midpoint. And so if you're waiting for it to come all the way down here, you may miss some of these entries, all right? But at the same time, if you go to a 15-minute chart, these will look like entries, but what if the price, wants to retrace further? So on the 15-minute chart, you might get that entry, but on the 1 hour chart, it's still coming down. All right. So you have to kind of decide what your risk is. Do you sit and wait on the 1 hour chart for a deep enough pullback where this oscillator comes all the way down here? Or do you go down to like a 15-minute chart where you'll get more entries, but you run the risk that, that might be a false entry and maybe the price is not done retracing, such as like what we had here, right? This is a very tiny little candle anyways, but you could have taken a long right here and then the price immediately started going down. It was a false signal, okay? Up here, you would have gone long right here, right at the top, and what did the price do? It came all the way back down. So you would have had drawdown from about here to here. But that's the risk. But like I said, on the other hand, if you're waiting, you would have missed this signal right here on this time frame because you never got this back here. And you would have missed this signal right here too, because it never got back down into the oversold area. Now, the other thing you could do is you could say, okay, well, on the higher time frame, I'm only going to wait for price to get to around the 50 level, and I'll look for my entries there. That's another option too. It's really the same thing as going to the 15 and waiting for the oscillator to come all the way down. And, staying on the 1 hour and just letting it come halfway down. All right. It's really just all you're doing is making it fit. And that's not always a great thing. But at the same time, what we're looking for is market structure too. So where is our current market structure? Well, when we started making this high right here, off this low to this high, this was our market structure. Price came down. This is not a valid swing low because it didn't lead to a new high up here. So I would ignore this one. So the recent swing low is actually here. Price came down right to here. That's probably about a 50% retracement. And then it went up. So you can use Fibonacci and you can say, okay, well, as long as it retraces at least 50%, I might be open to then looking for it. And then you can use the oscillator as a secondary. If you like Fibonacci, you can use the oscillator as a confirming signal. And either, like I said, on this time frame, wait for it to get it, down closer to the 50 range, or just drop down to your 15 and wait for it to come down into here, back towards the oversold down to the 20 range, and then take it off of there. Okay. So the bottom line is on natural gas is I'm looking for longs. So I'm going to wait for pullbacks. And now that we've made a new high, where is our current swing low? Well, it's right here. So here's our current swing low. So as long as price stays above here, I'm going to look for some kind of, now this might go high. I don't know how high this is going to go before it pulls back, but let's say it's going to pull back from here. So we're going to wait for some sort of pullback down. Again, from a fib standpoint, at least a 50% fib. We want to see this oscillator cruise back down. All right, maybe we go to the 15-minute. All right, and we wait for this oscillator to kind of move, back down towards oversold, this way. And, and again, some sort of fib up here to at least like the 50% level. So, at least back to here. If it comes deeper, no problem, as long as it doesn't violate this swing. And you can see this is being held up by the 200 period moving average, which is also really nice. Okay, so maybe this comes down and the 200 keeps, adjusting with the price. And, a perfect confluence would be to have it come down, hit the 200 period somewhere over here, right? At the same time, the oscillator's down at oversold. Okay, and a Fibonacci on here shows it at a key fib level. Boom, you'd have three confluences, and that would be a great trade. So that's what I would do this. But either way, long story short, looking for longs going forward right now on gas. All right, so on to this is the Russell 2000, which is another stock index. It's like the Nasdaq or the S&P. It's just a different one. Not as popular as the other two, but and you can see here, again, we basically have some higher highs and higher lows. We basically have an uptrend. This is the hourly chart. And where's our most recent swing low? It's probably right here. All right, because you can see this low when price pulled back here. It led to a new high. We had this move up, and it led to new. Well, actually, you know what? I'm going to take that back. This pullback did not lead to well. This is a tough one because we had price come down right here. Okay, so we had this high put in. Price came down. When it came up here, it did not put in a new high, and then it pulled back again, and then finally it put in a new high over here. So the question is this our swing or is this our swing down here? All right, I'm going to put it here actually. All right, so I'm going to put the swing here, and I'm going to consider this all like basically one move up. Okay, so this is kind of our swing low right here, which you can see if we draw the line over intersects with the 200. And so basically what we're looking for now is to see some sort of move back. We actually, on this time frame, we actually have come back down near the 20 level. And you can see I had this arrow drawn in here from the other day. And, potentially we could see a rally off of this area here. All right. From a Fibonacci standpoint, off of this swing, where are we right now? We are right at the 50% retracement, so we'd be okay with that. So there you go. So I'm still long on this. The question is from where? This is the hourly chart. This is one of those ones maybe where you could actually take these signals right from the 1 hour. Like I told you, the oscillator is going to act differently with different assets, even on the same time frame. So if you look at 3 different markets with the same oscillator, 3 different markets, all on the 1 hour time frame, you're going to see the oscillator do different things. So here, we're back down near the oversold area. Now, we would have missed this signal if we were waiting for that right here. You can see price only came to the 50 level and went up. So again, this is what I was talking about with gas, where you can either take your chance at the 50 level and go long, okay, but you can see what would have happened here at the 50 level. We had this candle right here. So if you waited for price to come to the 50 level here, right, and you went long right here, you would have been in drawdown if not stopped out. And I don't know if you were stopped out, depends where you had your stop loss, but you would have seen this candle in real time, so this bullish candle, and say, okay, we're going back up now. You go in long, you put your stop right below it, and then boom, it immediately starts to roll over again and you get stopped out. Okay. Now, if you had your stop maybe a little further away, like I said, 2 swings away, so instead of this swing, you put it here, you'd still be in the trade, but you'd still be in drawdown. So again, this is the risk balance you have to weigh about where you're going to take your signals from. All right, whether you're going to take it from here or whether you're going to take it from you're going to take it on this time frame or a shorter one. If we go to the 15-minute, all right, you can see here you're going to get some false signals here. We had this long entry right here. Price started to go up and it failed, went down again, and now we're getting another signal right at the close on Friday. This one's potentially better because we went up, tried to pull down, and then started going up again. Of course, the market closed at that point, so we kind of ran out of steam for the week. Okay, so again, there's always going to be risk to reward on these, on what time frame you want to take your signals off of, especially using this oscillator. All right, so that's why your market structure levels are helpful. That's why you can do things like use Fibonacci's. Because what was that false signal on the 15-minute? It was it was right here, right? This was our fault signal on the 15, was right here, right here. So if we go back to the hourly chart, if we put a fib extension on this, right? Let's see where the fib comes to on that. Here's that entry right here. It's at the 38.2, which is a valid fib level, but it's not as good of a fib level as below the 50. 50, 61.8, 78.6, even down to 100%. The 38.2 is probably the least reliable, like the 38.2 and the 23.6 level. Generally, price is going to pull back deeper than that. So if you use a fib on there, and you said, I'm only going to take signals from 50% or better, then you would have not have taken that trade anyways, and you would have avoided that false signal. Although, I can see in real time this looked pretty good on this time frame. Like, oh yeah, here we go, going up again. And, it goes up for about an hour and then boom, it crashes down again. Okay. But now we're at, about the 50% retracement where we're currently sitting. All right. And so let's see what happens on Monday. But either way, looking for longs on here on the Russell 2000. Okay. All right. And last on Euro USD futures, and this will be the same for your Euro USD spot Forex. You can see I've already kind of drawn some in here. Here is our recent swing, which was held by the 2 hour, the 1 hour, the 200, the 200 moving average. Held this, but this is a 20-minute time frame. And you can see here, price went up, made a new high, which makes this a valid swing low. Okay. And then we came up here, and now we're pulling back. And you can see, essentially what I'm looking for. See a deeper retracement. Okay, a little bit further retracement. That would get this oscillator closer to oversold. And then look for some bullish price action, and the oscillator start to turn back out of oversold, and that would be a long signal. And so if we look at a Fibonacci, we're sitting currently, we closed that at the 38.2 is about where it closed. It momentarily hit the 50, but it closed back higher. So I'd like to see this come down a little further, get back down towards the 61.8 or so, or a solid close at least at the 50. And then see where the oscillator is and potentially look for longs from here. So this is the 20-minute chart, and we could potentially see an entry, somewhere here. And if we drop to a 15-minute, if we drop, that's why I like the 20. The 15 may start giving you a little bit more in terms of fault signals. Like right here, we had this fault signal. Right, so if we had gone long right here, this was a false signal because you can see price kept going down, tried to go up, got you back to about break even, then went down again. But if we go to the 20, there's no buy signal here, right? Because the oscillator was still turning down. And this is what I was talking about, having to kind of tweak the time frame where this oscillator gives you the best signal. And maybe on this asset, it's this 20-minute time frame. All right. So, but essentially, again, I'm looking for longs here on this asset, Euro USD futures, to head back to the upside. Okay. And this was our previous swing, led to this new high. I don't really consider this. This is not a valid swing area because, again, price kind of came up here, pulled back, but you can see when it went up, it didn't make a new high. So we did not, even though this came down to here, we did not violate any structure. The structure still is sitting here. And so this, this was our previous swing low. Okay. And then when price came down here and then went up, made another new high, this became our new swing low. So we can get rid of this one now. All right. But I just wanted to point that out, that this move down was not a violation of any market structure because I didn't consider this to be a valid swing right here. It's down here. Okay. And price held that, and it was also held by the 200 period moving average on this time frame, and then it went back up. So let's see what happens next week. But essentially, again, long story short, would like to see a deeper pullback here, on this market. Have the oscillator pull down closer to oversold, all right, or at least get down here somewhat. And again, if you wanted to use a fib extension, a Fibonacci retracement, just as a another confluence, to have it go 50% or better, then fine, do that. And then we're just going to look for some bullish price action, a strong bullish candle back up. And to me, that would be a good buy signal. Okay. So there you go, guys. That's it. So long on the euro, long on the Russell, long on natural gas, neutral on crude oil, potentially bearish, but neutral right now, just the way this stands. So, all right. So that's the 200 period moving average, which is a great long-term trend. You will find often that price respects that moving average to the T. On certain time frames, it's going to do that. But it's just a good visual snapshot to say, okay, where is the overall trend? But again, if you see that moving average moving sideways, and like we kind of have right now, it's not, from about here to here, it's really not making any progress. If we look at where the moving average is closed on Friday, basically from here to here, it's moving sideways, right? It started going down, then it came back up. So, and you can see the market's pretty choppy here, right? It's below the moving average, now it's above. Tried to go below, now it's above again, but not great. And I'm not saying it won't go and smash right through here and keep going up, but I'm saying just visually looking at this, to me, it's not obvious what the trend is because the recent price action is very overlapping and it's not making a lot of progress and it's just kind of moving sideways. So we can extend this line over, extend this one over and say, okay, well, I want to see price definitively break above this high, and then my bias will become more bullish. Or if we break down and we take out at least this low, maybe start trading definitively back below the 200, below this low, or certainly below this one, then that would be more bearish. But in the meantime, I would ignore these signals. I would ignore anything on here unless you're scalping on a short time frame. But I'm talking about like this 30-minute to 1 hour time frame. I don't find this to be a good area to trade this market right now. So we'll sit and wait on this one. All right. Anyways, guys, I'm going to leave it there. I hope that was helpful. 200 period moving average, simple moving average, and a 15-3-10 stochastic. A nice, day trade to short-term swing trade setup. And you just got to determine, the best time frame, best way to tweak it in terms of, where you want to take your signals off of. A lot of that's just a personal choice of your own risk tolerance and doing a little back testing and see on any particular market. If you back test it, using these two indicators, well, go back and see what time frame generated the best reliable and most consistent signals. Not every one of them, no matter what time frame you look at, not every one of them is going to be good. There's going to be some false signals, no matter what time frame you use. There's going to be some times where you miss a trade if you're waiting for, overbought or oversold. Even if no matter what time frame you look on. So don't expect to find the perfect one because you're not going to find it. But just do a little bit of back testing and find which one overall provides the most consistent signals, the best signals. And if there's 5 signals and 3 of them are winning signals and 3 or 4 of them are winning signals and 1 or 2 of them are losing signals, then that's pretty good. All right. And just play around with it and see. All right, guys, any questions, comments, leave them down below. Smash that like button, subscribe to the channel, and I'll be back next week. Like I said, Monday's a holiday, so I probably won't be doing much on Monday, but we'll be back after that. All right, guys, take care. Have a great weekend.